You can lose money in the market without making a single bad prediction. You can lose because you entered too early. You can lose because you were afraid to take a small loss. You can lose because one winning trade made you believe you couldn't be wrong. And sometimes, you lose because you knew exactly what you were supposed to do and did the opposite. That is the part nobody wants to talk about. The market is not always your biggest enemy. Sometimes, you are, because trading does not begin with money. It begins with behavior. And if your behavior does not change, increasing your account size only increases the size of your mistakes. This is the real journey from zero toward $1 million. Not a fantasy about turning a tiny account into a fortune. Not a promise that the market will make you rich. A journey through the decisions, mistakes, emotions, discipline, and patience required to become the kind of trader who can survive long enough to compound skill. And few historical traders provide more useful lessons for that journey than Jesse Livermore. Not because every decision he made was perfect, it wasn't, but because his career became a remarkable study in speculation, timing, risk, psychology, discipline, success, failure, and the consequences of losing control. His story forces us to confront an uncomfortable question. What if the biggest obstacle between you and becoming a better trader isn't your strategy? What if it's you? Imagine a trader sitting in front of his screen. He's been watching the market for hours, nothing. Then suddenly, price moves fast. A candle breaks through a level. Momentum appears. His heart rate rises. He thinks, I have to get in now. He enters. For a few seconds, everything looks perfect. Then the market pulls back. Not much, just enough to make him uncomfortable. His original stop is sitting below the level. He knows where he should exit. But then another thought appears. It's just a pullback. So he moves the stop. The market falls again. Now he's losing more. He adds another position. Why? Because he doesn't want the first trade to be wrong. The position gets larger. The loss gets larger. And suddenly, he isn't trading the market anymore. He's negotiating with reality. He is trying to force the market to prove him right. That is where the real damage begins. Not on the chart, inside the mind. One of the most important lessons associated with Livermore's approach was the importance of waiting for the market to confirm an idea, rather than acting, simply because an idea seemed attractive. That distinction sounds simple, but living it is difficult, because human beings hate uncertainty. A trader sees a stock rising and wants to buy before it goes higher. He sees a stock falling and wants to catch the bottom. He sees a breakout forming and wants to predict it before everyone else. The mind tells him, get there first. But the market doesn't reward you for being first. It rewards you only if your decision is correct and your risk is controlled. Sometimes the best trade is the trade you don't take. And that can feel unbearable, because doing nothing feels like losing. You watch the market move without you. Price rises. You were right, but you weren't in the trade. And now comes the dangerous thought. I missed it. That sentence has destroyed more discipline than many losing trades ever could. Because now the trader isn't analyzing, he's chasing. Picture the same trader again. The market has moved significantly. He enters late. At first, the position moves slightly in his favor, then it reverses. He takes a loss. Now something changes. The loss isn't just a number anymore. It feels personal. His mind says, I need to get that money back. So he searches for another trade. Not because his setup is there, because his loss is there. This is revenge trading. And revenge trading is not really about revenge. It's about emotional correction. The trader wants the market to erase the feeling he has inside. He doesn't want to accept, I was wrong. So he takes another position, then another. The first loss becomes 2 losses. 2 become 3. And eventually the trader isn't trying to make a good decision. He's trying to escape the consequences of a bad one. This is why risk management is psychological. A stop loss isn't just a technical tool. It is a boundary between what you control and what you don't. Without that boundary, a small mistake can become an emotional crisis. There is another trap. Winning. Losing can destroy confidence. But winning can destroy discipline even faster. Imagine you finally have a good week. 3 trades work. Your account grows. You begin to feel different. You start believing you've figured something out. You increase your position size. Then you take a trade that normally wouldn't qualify. You tell yourself, I have room for it. The market moves against you. But now your confidence makes the loss harder to accept. You don't think, my setup failed. You think, the market is wrong. And that is a dangerous transformation. The trader has stopped measuring the trade. He is measuring himself. Every winner becomes proof that he's smart. Every loser becomes a threat to his identity. Now trading becomes emotional. And once trading becomes emotional, even a good strategy can be executed badly. This is where the story of Livermore becomes useful. His career is often remembered through spectacular speculation and enormous financial swings. But the deeper lesson is not simply about making large amounts of money. It is about understanding that market success requires a different relationship with uncertainty. You cannot control the market. You cannot force a trend. You cannot command a stock to move. You cannot make a prediction become reality through confidence. You can only control your preparation, your entry, your risk, your position size, your patience, and your response. That is a much smaller circle. But it is the circle that matters. Here's the contradiction. Most traders spend years trying to control something they cannot control. They search for the perfect indicator, the perfect entry, the perfect strategy, the perfect prediction, but they neglect the one thing that actually sits inside their control, their behavior. The problem isn't that you don't know enough. The problem is that you may already know enough to trade, but not enough to control yourself. You know you shouldn't chase. You chase, you know you shouldn't move your stop. You move it. You know you shouldn't overtrade after a loss. You do it anyway. You know you should wait for confirmation. But the moment the market moves, patience disappears. So perhaps the question isn't, how do I find a better strategy? Perhaps the better question is, why can't I follow the strategy I already have? That question changes everything. Let's go deeper. Why does a trader enter too early? Because waiting creates psychological discomfort. He imagines someone else getting the move. Why does he move the stop? Because accepting a loss feels like admitting failure. Why does he add to a losing position? Because he wants to make the original decision right. Why does he revenge trade? Because he wants emotional relief. Why does he become reckless after winning? Because success creates overconfidence. Why does he break his trading plan? Because the plan represents logic, and the live market activates emotion. That is the battle. Your trading plan is written by your rational mind. Your trades are often executed by an emotional mind, operating under uncertainty. Those two versions of you can want completely different things. One wants consistency, the other wants immediate relief. One wants long-term growth, the other wants today's loss back. One understands probability, the other wants certainty, and the market exposes the difference. Consider a trader who starts with a small account. He has no advantage from size, no professional infrastructure, no enormous capital, so he becomes obsessed with making the account grow quickly. He thinks, if I can just double it, then double it again, then increase the size, then maybe I can reach 1 million. But this creates a dangerous psychological trap. He stops thinking about becoming a better trader. He starts thinking about becoming a richer trader. Those are not the same thing. A trader focused on money asks, how much can I make today? A trader focused on process asks, how much am I willing to risk for this idea? The first question creates pressure. The second creates structure. And pressure changes behavior. When every trade has to produce a result, you stop allowing probability to work. You force trades. You increase size. You become impatient. You begin treating the market like a machine that owes you an outcome. It doesn't. So what would the journey actually look like? Not $0, 1,000, 10,000, 100,000, 1 million. That's the fantasy version. The real journey looks more like this. Ignorance, then awareness, then mistakes, then self-awareness, then discipline, then consistency, then controlled growth, then the ability to handle larger amounts without changing your behavior. The real milestone isn't the number in the account. It's the person operating the account. Because if you cannot control a small position, giving yourself a larger position won't solve the problem. It will amplify it. This leads to the first rule, Rule 1. Protect your ability to keep playing. Risk management comes before profit. Every trade should have a clearly defined amount you're prepared to lose before you enter, not after. Before. Why? Because once you're inside the trade, your emotions change. Before entry, a loss can look like a simple percentage. After entry, that same loss can feel like a threat. A disciplined trader decides risk while calm. An emotional trader negotiates risk while under pressure. That's why moving a stop farther away is so dangerous. You're not simply changing a number. You're changing the agreement you made with yourself. The market didn't force you to do it. Your emotion did rule. 2. Don't confuse movement with opportunity. A market can move dramatically without offering a good trade. This is one of the hardest lessons for beginners. They see a stock running and feel something inside them saying, go. But movement is not confirmation. Excitement is not confirmation. Fear of missing out is not confirmation. A disciplined trader can watch a major move happen without participating. That feels terrible at first, but eventually, something changes. You realize, missing a trade costs nothing. Taking a bad trade costs something. That distinction is powerful. There will always be another opportunity. You don't need this one. Rule 3. Let the market prove your idea. This connects directly to the patience associated with Livermore's trading philosophy. Instead of constantly predicting what will happen next, observe what the market is actually doing. A trader might believe a stock is preparing for a breakout. Fine. But believing it doesn't make it happen. Let the market confirm the idea according to your tested criteria. This doesn't eliminate losses. Nothing does. It simply prevents you from risking money based entirely on imagination. The disciplined trader doesn't need to be right early. He needs to be right when it matters. Rule 4. Cut the loss before the loss becomes emotional. A small loss is information. A controlled loss is part of trading. But when a trader refuses to accept a small loss, the trade becomes a psychological battle. He starts thinking, it has to come back. Maybe it does. Maybe it doesn't. But that isn't the point. The point is that he has abandoned his original risk structure. Livermore's historical lessons repeatedly emphasized the importance of accepting losses rather than allowing them to grow uncontrollably. The disciplined trader understands something painful. Being wrong is not the problem. Refusing to admit you're wrong is the problem. Rule 5. Never let one trade become your identity. You lose, so what? You win, so what? Neither outcome defines you. A losing trade doesn't mean you're a terrible trader. A winning trade doesn't mean you've become a genius. Both are data. The moment you emotionally identify with your trades, you become vulnerable, because now you'll defend your position to defend yourself. That's when confirmation bias appears. You search for information that agrees with your position. You ignore information that challenges it. You interpret neutral events as positive. You dismiss warning signs, not because the market changed, because you changed the way you see the market. Rule 6. Stop measuring yourself by today's result. This may be the hardest rule of all. A professional mindset understands that one trade means almost nothing. Even several trades may mean very little. A strategy is judged over a meaningful sample of trades, not one emotional afternoon. Your job is not to make every trade profitable. Your job is to execute your process consistently. Think about a casino. The casino doesn't need to win every hand. It needs an edge and disciplined execution over many outcomes. A trader needs the same respect for probability. One trade can be unlucky. One trade can be brilliant. Neither tells the entire story, but your habits reveal the story. Now imagine our trader 6 months later. He hasn't discovered a magical strategy. He hasn't found a secret indicator. He hasn't eliminated losing trades. Something more important has happened. He has stopped fighting the market. He takes fewer trades. He waits longer. His losses are defined. He doesn't move stops because he's uncomfortable. He doesn't chase because another trader is making money. He doesn't immediately trade after a loss. And when he wins, he doesn't suddenly believe he's invincible. Nothing about the chart has become easier. But something inside him has changed. He has learned to separate opportunity from emotion. That is the turning point. And then one day, he takes a trade. The setup is valid. The risk is defined. The market moves against him. He gets stopped out. The loss is real. But he doesn't chase. He doesn't add. He doesn't revenge trade. He closes the platform. And for the first time, he feels something strange, pride. Not because he made money, because he followed his plan. That moment is more important than a winning trade, because now he understands the real game. Trading is not the art of avoiding uncertainty. It's the art of making decisions while uncertainty exists. This is where the dream of reaching $1 million needs to be reframed. $1 million is a number. It can be a goal, but it cannot be your psychological foundation. If your entire emotional state depends on reaching a specific amount, every setback becomes unbearable. Instead, build the person capable of managing capital responsibly. Learn to preserve capital. Learn to recognize quality setups. Learn to wait. Learn to accept losses. Learn to avoid unnecessary trades. Learn to review your decisions without excuses. Learn to increase risk only when your process and circumstances justify it, not because you're impatient. And most importantly, learn to remain the same person after a win and after a loss. That is consistency. There is a deeper lesson here. The market doesn't just reveal whether your strategy works. It reveals who you are under pressure. If you're impatient, trading exposes it. If you're greedy, trading exposes it. If you need to be right, trading exposes it. If you cannot accept uncertainty, trading exposes it. And that can be uncomfortable, but it can also be useful, because once you see the pattern, you can change it. You can't improve a behavior you refuse to acknowledge. So why do traders know what they should do, and still do the opposite? Because knowledge is not behavior. Knowing that you shouldn't revenge trade doesn't stop revenge trading. Understanding risk management doesn't automatically create discipline. Reading about patience doesn't make you patient. The gap between knowing and doing is where the real work happens. And that gap is built from repeated decisions. You close the bad trade. You wait for the setup. You accept the missed opportunity. You follow the plan after a loss. You resist increasing size after a win. One decision, then another, then another. Eventually, discipline stops being something you think about. It becomes something you do. This is why Livermore's story should not simply be studied as a story about wealth. It should be studied as a study of human behavior. Markets have changed. Technology has changed. Trading platforms have changed. Information moves faster than ever. But human emotions have not changed nearly as much. Fear is still fear. Greed is still greed. Impatience is still impatience. The desire to be right is still the desire to be right. And the market still punishes undisciplined behavior. That is why these lessons remain relevant. Now return to the trader who wanted $1 million. At the beginning, he believed the journey was about finding the trade that would change his life. Eventually, he learned something different. The life-changing trade wasn't the point. The life-changing skill was learning how to make decisions repeatedly, without allowing emotion to take control. He stopped asking, "Where is the next big winner?" He started asking, "Is this trade part of my process?" He stopped asking, "How much can I make?" He started asking, "How much can I responsibly risk?" He stopped asking, "How can I recover this loss?" He started asking, "What did this loss teach me?" That is the psychological shift, and it changes everything, because the amateur trader is obsessed with prediction. The disciplined trader is obsessed with preparation. The amateur wants certainty. The disciplined trader accepts probability. The amateur wants to avoid being wrong. The disciplined trader wants to control the damage when wrong. The amateur chases opportunities. The disciplined trader waits for them. The amateur measures success by money. The disciplined trader measures success by execution. And strangely enough, trader who becomes obsessed with execution often has a better chance of allowing results to develop naturally over time. Not guaranteed, not easy, not fast, but sustainable. So if you're watching this after a losing streak, don't immediately search for another strategy. Stop. Look at your behavior. Did you enter because the setup was valid? Or because you were afraid of missing out? Did you move your stop because the market invalidated your idea? Or because you couldn't accept being wrong? Did you increase your position because the opportunity justified it? Or because you wanted to recover? Did you take that last trade because your system gave you a signal, or because you were angry? These questions may reveal more about your future as a trader than another 100 indicators ever could. The road from 0 to $1 million isn't a straight line. There may be setbacks, there may be losing periods, there may be mistakes. And for many traders, the greatest danger isn't losing money once. It's repeating the same mistake until the account confidence and discipline disappear together. The goal is not to eliminate every mistake. The goal is to stop making the same mistake unconsciously. Review it, understand it, build a rule around it. Then execute that rule the next time the same emotion appears. That is how experience becomes skill, and eventually, the trader realizes something almost paradoxical. The market didn't need to change. He did. The charts didn't become easier. He became more patient. The losses didn't disappear. He learned how to contain them. The uncertainty didn't disappear. He learned how to operate inside it. The temptation didn't disappear. He learned not to obey it. That is what becoming